You know how everywhere you look, people are claiming either a repeat of 2008 and a huge crash, or a continued real estate boom? Wouldn't it be nice to have a grounded, sensical, and evidence-backed forecast for where the housing market is headed in 2021? Well, the truth is no one really knows, but if someone were to have the highest likelihood of being correct, it would be Windermere chief economist Matthew Gardner. He's one of the most well-read, respected, smartest, and objective thinkers in this space. And today, we bring you his annual forecast. Hello everyone, JT Putt here with Windermere Real Estate. Here in Colorado, and in the Denver metro area specifically, housing prices have been going crazy. We are going to highlight some of the great insights that he brought to us about the Jefferson County and Evergreen markets. We are simply highlighting about a 3-minute portion of an hour-and-a-half presentation. If you want to watch his entire regional and national economic forecast, I'll go ahead and link to that in the description below.
Jefferson County. Well, what happened? You look at over 1,600 units on the market in 2012, down to about 180 now. It's a lot, but at the same time, it was a massive drop. At the same time, however, the demand factor is massive. I mean, we're seeing a lot of closings. We're now probably almost over 1,000 units above that long-term average, because, well, prices again have been rising, almost doubled over the course of the last 8 years. Bit of softening there. Year-over-year prices are still up by north of 10%, and a lack of supply. And we're not building enough new homes in this county. That's kind of fascinating to see. Look how low it is relative to historic levels. So we're not seeing that level of supply. If that picks back up, that's gonna be a good thing, but it is just not there yet. And because of that, you could say, well, doesn't that mean that existing homes are going to take more share? Well, yeah, look at where we're seeing average sale prices above $1 million in December, in fact, in the month before, and a significant price premium. People are certainly in that market paying more, not just for the house itself, but they are still commanding that premium. And so because of that, we're unlikely to see. The question then becomes, how deep is that demand point? And once you get into 7 figures, that certainly pulls back significantly. So it is a smaller market, but it is an expensive market. Prices rose significantly last year, almost shy of 9%. Expect to see about 4.4% growth in prices this year, above what we saw in 2019, where it wasn't quite as affected as some other markets, but a softening in prices, which I think is a reasonable thing to do. And obviously it's something which you can see across the board. It is almost endemic, and it's applying nationally. We're seeing it in Washington. We're seeing it, quite frankly, across all of Windermere's footprint.
When we say inventory, we mean the amount of houses available for sale. These stats highlight the inventory shortage in Jefferson County. With so few houses on the market, it simply means that the supply side of the supply and demand equation is so low that it's driving prices up. The other thing that we're seeing in Evergreen is a bit of a logjam. People are not putting their homes on the market, which contributes to inventory staying low because they don't have great options for places to move into after selling their home. That's where the new construction comes in. Hopefully we'll see more building permits pulled in 2021, as Matthew alluded to.
Ultimately, what do I see in your region? I think that it is a housing market which has done well. Certainly if you look at it over the course of the last several years, we know that your economy has diversified significantly. You're seeing a lot more businesses come in, certainly energy-based businesses moving into Colorado. And I think that the lifestyle as well is something that's going to attract more companies to move into your area. That is going to be a positive for housing. I think you've got the land. I wish you'd be pulling more permits. Unfortunately, you're not doing that, at least to the degree I'd like to see yet. That is still putting pressure on resales. But at the same time, I think what's important is that from a home seller's perspective, for example, we've been used to some very, very high rates of appreciation. The belief that our own homes are worth a considerable amount of money, and they are certainly, but we are going to get back to a more realistic market, and that's important. But the trouble is that most of us have very short memories, and we think, well, hang on, no, what do you mean that prices aren't going to be going up by 10-12% per year forever? It doesn't work, and that is just a point of fact. Housing in aggregate and locally has been a very massive positive to the local economy, regionally, and also nationally. It is, some are calling it the super V in terms of the recovery. A lot of people actually thought that wasn't going to happen. They expected the housing market was going to collapse. It didn't, and I certainly don't expect it to do so. We're going to see a lot of demand. You're going to see a lot of demand from first-time buyers. I can't reiterate this enough. They're going to be a major component of the housing market. You've actually seen more people coming in to the metro area, certainly in Denver, than moving out. So you're not seeing that mass migration out, but you will likely see people potentially moving away from some of the job centers if they think they can find a home that is more affordable. It's certainly something we're seeing here in Western Washington, where King County, here where I am, horribly expensive. People are moving out either north or south, and they are either paying all cash or putting 50, 60% down payments. But again, they're not moving out into the middle of nowhere. They still want to be, in essence, proximate to our job centers. COVID-19 has created an interesting dynamic in the housing market. I think it's going to pull a lot of demand forward. There's no doubt about that. That is going to come from those first-time buyers, potentially even more so, as I mentioned earlier, because of the first-time buyer tax credit. I think also people are going to look at their homes realizing that they are going to be working from home semi-permanently, for example. And again, that's that couple of days a week here and a couple of days a week in the office. And many of them may realize that they don't have a dedicated workspace. I mean, I'm one of them. I have been working from my dining room table since the 13th of March last year. I'm not going to move, but I think a lot of people will. And they'll do it in order to have a dedicated space. Now, for those people that are saying, well, I want to move, but I don't have that dedicated workspace, so perhaps my home won't be as competitive. Well, that can be the case, but we're actually, amazingly enough, seeing people, even if they don't have per se an office, creating dedicated Zoom spaces within their homes. That's an interesting concept. I will tell you something else. As Eric mentioned, I do get interviewed on television a lot. I have done more television interviews with reporters calling me or speaking to me either from their cars or from their bedroom closets than anywhere else. Very, very unique. Now, because the work from home scenario, again, it's not going to be temporary. It's not going to go away. A lot of people, where they are able to, will be working from home, but more than likely most of them part-time. And in essence, the reason for that is that we miss that symbiosis of discussions around the water cooler. And I think productivity issues can be in place, even though we have Zoom. But productivity is interesting as well. Why? Well, my example is always, if I was in my office and maybe one of our co-presidents, let's say Obi Jacoby, wants to ask me a question, well, he'll come to my office door, ask it, and walk away 3 minutes later. Well, that 3-minute telephone conversation one-on-one has turned into a 30-minute Zoom call. And that can lower productivity. And from an employee perspective, training is an issue online as well. So I really do expect to see that split between our homes and our offices. I also think, again, I mentioned earlier, people will get bored with what they've got. They'll look around and say, I just want to move because. It's somewhat unusual, but I do expect to see that. So we are going to see, I think, greater turnover, and turnover being the sale of existing housing. I am hopeful we'll see more permit activity occurring. We know that costs are very high for builders, but as some of them look at either some of those secondary neighborhoods or even secondary markets because of lower price and greater availability of land, we'll probably see more activity in that market too as well. So that all these things in concert, I think, will take some of the price pressures off the existing housing inventory. We'll see more turnover. I expect sales to be up in your area across the board, as they are going to be across the country. I'm very pleased that we are, as a company in the Western United States, we're still performing very admirably, not just from an economic recovery standpoint, but also from a housing standpoint. Now, we are still seeing foreclosure rates very high in markets or states like Louisiana, Alabama, New York. But where are some of the lowest? In Colorado, in Idaho, in Washington State as well. So we're seeing really a bifurcation in that respect. Home prices will rise this year. I expect mortgage rates, however, are going to slowly trend up, but 4% mortgages are, I would argue, a 2022 story at the earliest. Higher than we've seen, but I certainly don't see them going down any further. Demand's going to be there. Demand not just from first-time buyers, but demand from people who are going to look to move further out into a different home that more satisfies their needs. And the housing market, finally, I guess I'd say, is that there are still people out there who are hoping that we are on the cusp of the bursting of another housing bubble. I just don't see it, and I really don't. Why? Well, qualifying is still remarkably hard. Yes, prices have gone up by above average rates, but they are going to trend down because, in essence, there must always be a relationship between home prices and incomes. Now, we've offset that because mortgage rates dropped by 1 percentage point last year. If they don't drop any further, they start to notch up a bit, and we don't see that income growth. Again, it really says to me a slowing down in growth, not turning negative. And I'm afraid that the naysayers out there who believe the housing market's going to crash again, most of them, by the way, because they can't afford to buy a home, well, yet again, for another year, they're going to be wrong. I hope that you found interest in my comments today. I know we had a lot to get through, and I'm thankful for you being so patient with an old English guy who tends to speak way too quickly. But I think I will close with this. We went through a health crisis, not a housing crisis. Housing and the economy was performing very, very well back in January and in February. We turned the economic lights out, not just because of the normal reasons we enter a recession, but because of a bug. And so because of that, as we start seeing that recovery, yes, it's a bifurcated one and more improvement coming in the second half. It's also the recovery is somewhat K-shaped. Now, what do I mean by that? I think businesses or employees that are able to work from home, I don't know anyone that lost their jobs because of COVID-19. And so we've done well. Yet, however, those face-to-face industries, yes, leisure and hospitality, significantly impacted because of declines in employment in bars, in restaurants, and in hotels. But we have not seen that elsewhere. And so the K-shape being is that the haves, who do tend to be, by the way, home owners as opposed to renters, are doing very well. The have-nots, those in those service industries, have been suffering. Again, most of them are renters. They are still having a very hard time. I feel very sorry for them. But at the end of the day, the ownership housing market is going to do well. I expect to see the rental market, I'm afraid this year is going to be a tough one for them in many parts of the country because of the moratoria on evictions that's in place, at least right now.
Well, there you have it, the Cliff Notes version of Matthew Gardner's 2021 economic forecast. We really hope that you found something helpful in this video. If you have any other real estate questions, please don't hesitate to give us a shout. We're here to help. Thanks everyone. Have a great rest of your day.